Silver has shot up roughly 18% in a single month. And while you're hearing shouts of $100 silver, many are ignoring a critical warning sign that came right before the last two major crashes. So, is this the breakout we've all been waiting for? Or are investors walking straight into a trap? After a wild surge took the price to nearly $59 an ounce, the silver market is at a crossroads. This isn't just another rally, it's a move that has investors on the edge of their seats. We're seeing prices hold near their nominal all time highs, a move that means silver has nearly doubled in value year over year. This is the kind of parabolic move that can define a market for a decade, but where there's great reward, there's always great risk. History has shown us that moves like this can end in only one of two ways: a moonshot to unbelievable highs, or a catastrophic collapse that wipes out fortunes. So, the big question we have to tackle today is this: is the current silver rally for real, or is it a bubble just waiting to pop? Are we seeing 2011 all over again, or even worse, is this 1980? To figure that out, we can't just look at the price, we need to go deeper. We have to break down the powerful forces at play, from the engine room of the global economy at the Federal Reserve all the way to the physical vaults in London and Shanghai. We're going to look at the bull case, the evidence for a rocket ship to $100. Then we're going to play devil's advocate and lay out the bear case, all the reasons this could come crashing down. By the end of this, you'll have a clear, data driven framework to understand what's really going on and what might happen next. To get a handle on the explosive potential for silver, we have to start with the single most powerful force in finance: monetary policy. The bull case for silver isn't just about a shiny metal. It's a story of currency devaluation, a massive supply squeeze, and an industrial revolution in green energy. Let's call this the moonshot evidence, and it all starts with the Federal Reserve's next move. For months, the market has been obsessed with one question: when will the Fed cut interest rates? As of early December 2025, the market is pricing in about an 87% probability of a rate cut in the coming weeks. This isn't just a guess, it's the market screaming that the era of tight money is over. So, why does this matter so much for silver? It boils down to a simple idea called opportunity cost. When interest rates are high, government bonds look pretty good. You can park your money there and get a safe, predictable return. But assets like gold and silver don't pay you anything, they just sit there. So, when bonds are paying you 5%, the opportunity cost of holding silver is high. You're giving up that 5% return. But when the Fed starts cutting rates, the yield on those bonds drops. All of a sudden, that non yielding stack of silver in your vault doesn't seem so bad. The opportunity cost plummets, making it way more attractive to big money. This expectation of easier money, not just now, but potentially for a while, is acting like rocket fuel for precious metals. The smart money is getting ready for a world where cash and bonds pay less and real tangible assets become king. But the Fed is only one part of the story. The second, and maybe even more powerful driver for this bull case, is a severe and deepening supply squeeze. This isn't some far off theory, it's happening right now. For years, analysts have pointed to a structural deficit in the silver market, which just means we use more silver than we mine. That deficit has become critical, with the market facing shortfalls for 5 straight years. And this isn't just numbers on a spreadsheet. We're seeing the physical results in real time. Visible silver inventories on some major exchanges, like the Shanghai Futures Exchange, have hit their lowest levels in a decade. The vaults are getting emptier. At the same time, we're seeing record amounts of silver flowing into London, which suggests a mad scramble to get physical supply. This tightness is creating what's known as a scarcity premium. Dealers are reportedly paying significant markups for physical silver bars and rounds. This tells you that the demand isn't just from paper traders on the COMEX, it's from real people and industries trying to get their hands on actual metal. They're willing to pay more than the spot price because they're afraid they might not be able to get it later. That's the definition of a supply squeeze, and it's a profoundly bullish sign that the mainstream story often misses. Now, let's add another piece to this bull case: relentless industrial demand. For decades, silver was mostly seen as gold's poorer cousin. That view is dangerously out of date. Today, silver is a critical strategic metal, absolutely essential for the green energy revolution. Its unmatched conductivity makes it irreplaceable in making solar panels. Every single solar panel has silver in it. As the world pushes to meet climate goals, the demand for solar is non-negotiable, which means the demand for silver is non-negotiable. But it doesn't stop there. Demand is also surging from the booming electric vehicle market and the entire electronics sector. Every EV, every smartphone, every computer, they all need silver. So, while investors are buying silver as a hedge against inflation, a massive and separate wave of demand is coming from industries that need it to build the future. This industrial demand acts as a solid price floor, eating up a huge chunk of the annual supply, no matter what financial markets are doing. It's a constant growing drain on an already tight supply. The final piece of the bull case is the investor who is finally waking up to silver again. For the better part of a decade, silver was ignored, but this recent price surge has put it back on the map, and investor demand is now throwing gasoline on the fire. We've seen massive inflows into silver-backed ETFs, with total holdings climbing to their highest levels since 2022. This is financial demand chasing the price higher, and it's landing on top of an already critically tight physical market. When a wave of financial buying hits a physical shortage and strong industrial demand, the price has only one path of least resistance: up. The gold to silver ratio, a classic measure of value, has been shrinking and is currently in the low 70s. Historically, in precious metals bull markets, silver tends to outperform gold, which makes this ratio fall. The current trend suggests silver is just getting started on a major repricing compared to gold, and many believe it's still undervalued. When you put all the pieces together, a dovish Fed, a documented supply deficit, dwindling inventories, a scarcity premium, non-negotiable industrial demand, and a flood of new investor interest, the case for a moonshot to 100 doesn't just seem possible, it starts to look probable. The fundamentals are arguably stronger than they've ever been. If you're finding this breakdown valuable and want to stay ahead of the curve in the precious metals market, go ahead and subscribe and hit that notification bell. We're giving you the facts you won't hear in the mainstream, and you won't want to miss what's coming next. But now we have to look at the other side of the coin. For every argument for a moonshot, there's a counter argument for a devastating crash. Parabolic moves like the one we've just seen are thrilling, but they're also famously unstable. The history of the silver market is littered with the wreckage of bubbles that look just as promising as this one. So let's look at the evidence for a crash. The strongest argument for a crash is history itself. We have seen this movie before twice, and both times it ended in disaster for anyone who bought at the top. We need to talk about 1980 and 2011. First, 1980. The story of the Hunt brothers trying to corner the silver market is legendary. They believed runaway inflation would destroy paper money and started hoarding massive amounts of physical silver and futures contracts. Their buying, plus real inflation fears, drove the price from about $6 an ounce in 1979 to a mind-boggling peak of over $50 in January 1980. The mania was everywhere. But here's the thing. The rally was built on extreme leverage and speculation. In response, the COMEX exchange and regulators stepped in. They changed the rules, bringing in Silver Rule 7, and put heavy restrictions on buying with borrowed money. This forced the Hunt brothers, who were leveraged to the hilt, to sell. The result was a catastrophe. On a single day known as Silver Thursday, March 27, 1980, the price collapsed. Within a few months, silver was back at $10 an ounce, an 80% drop from its peak. It was brutal, swift, and complete. Now let's jump to 2011. The backdrop was different, but the psychology was almost identical. The world was still shaken from the 2008 financial crisis. Central banks had unleashed huge waves of quantitative easing, or QE. Terrified that all this money printing would cause hyperinflation, investors piled into hard assets. Silver went on an insane 3-year bull run, rocketing from under $10 in late 2008 to a peak of nearly $50 in April 2011. The calls for $100 silver were deafening. It felt unstoppable. But again, the peak was driven almost entirely by a wave of investment fear, not by a sustainable boom in industrial use. And just like in 1980, the fall was vicious. In just 5 trading days in May 2011, silver crashed over 30%, from 48 down to 33. The sell-off triggered margin calls and wiped out traders who were late to the party. By 2016, silver had bled all the way down to under $14 an ounce, a 70% collapse from its peak. The parallels to today are chilling: a massive, rapid price spike, widespread calls for $100 silver, a story driven by fears over monetary policy. This is what economists call irrational exuberance. Investors get caught in a feedback loop where rising prices create stories of easy money, which pulls in more buyers, pushing prices even higher. This becomes totally detached from reality and is held up only by emotion. The problem with fear-driven rallies is that they can collapse just as fast when that fear fades. The bear case says we are in the euphoric stage of just such a bubble, and history tells us the next stage is a painful crash. The second bear argument is watching what the smart money does. While retail investors and some funds are piling in, a parabolic price spike is often the perfect time for long term holders and producers to cash out. At these near record prices, every silver miner on the planet has a huge incentive to produce as much as possible. High prices also encourage recycling, which adds to the supply. And don't forget, investors who bought silver at $20 or $30 are sitting on huge gains. The temptation to sell is enormous. The small pullbacks we've already seen from the peak could be the first signs of this profit taking. Bears would argue that the smart money sells into the retail frenzy, leaving latecomers holding the bag. Finally, there's the wild card: market manipulation. For as long as there's been a silver market, there have been claims of price suppression by big banks. It's a controversial topic, but the bear case has to include the risk that any rally, no matter how justified, can be shut down by massive selling in the paper futures market. Whether these claims are true or not, they add to the market's wild volatility and represent a risk that every bull has to consider. So the bear case is clear. We are repeating a dangerous historical pattern. The rally is driven more by fear and momentum than solid fundamentals, creating the perfect setup for a crash. The ghosts of 1980 and 2011 are a stark warning that a fall from these levels could be swift and severe. So, we have two powerful competing stories. The bulls point to a perfect storm of fundamental support: a dovish Fed, a real supply deficit, and a green energy revolution that needs more silver than we can mine. The bears point to history, warning that the vertical price chart looks exactly like a speculative bubble, just like 1980 and 2011, doomed to collapse. So where does the truth lie? While you have to take the warnings from history seriously, there's a strong argument to be made that this time is different. The key difference between today and the peaks of 1980 and 2011 is the supply and demand fundamentals. The 1980 rally was mostly an artificial squeeze that was broken by regulators. The 2011 rally was almost entirely driven by investment fear after the financial crisis. The industrial side of demand was nowhere near as strong. Today's situation is unique. We have powerful investment demand and powerful industrial demand crashing into a documented structural physical supply deficit. This isn't a manufactured squeeze like the Hunt brothers tried. It's a real world shortage of a critical commodity. The fact that silver has held its ground near these highs, unlike the immediate sharp rejections in 1980 and 2011, suggests a much more solid foundation. Therefore, here's the verdict: the speed of this rally makes a short-term pullback or a period of intense back-and-forth trading very likely, maybe even a test of the $50 level. However, the underlying fundamentals suggest that the long-term path for silver is higher. The bear case is a warning against short-term volatility, but the bull case is a roadmap for a structural repricing. The 30 to 40% crash that bears are worried about is a real possibility in the short term, especially if market sentiment flips. However, the fundamental floor provided by the supply deficit and industrial demand is much stronger than it was in previous cycles. Some high-profile analyst forecasts see silver remaining elevated through 2026, with some scenarios ranging from the high $40 to over $65 an ounce. The moonshot scenario to $100 remains an aggressive outlier call, but one that gets talked about more if monetary easing speeds up or global risks get worse. So where does that leave us? Silver's incredible surge has brought it to a major turning point. The arguments for a crash, based on what happened in 1980 and 2011, are a powerful reminder of the dangers of speculative mania. The psychology of fear and greed is a force to be reckoned with, and you should expect a bumpy ride. However, the fundamental picture today is undeniably different and stronger. The combination of expected Fed rate cuts, a multi-year supply deficit, and relentless industrial demand from the green energy transition provides a powerful support system that just didn't exist during previous peaks. The most likely path forward is not a straight line. Expect battles between the bulls and the bears with major price swings. A healthy correction would not be a surprise, but the deep structural forces driving this market all point toward a higher valuation for silver in the years to come. This isn't just a fleeting moment of investor panic. It looks more like a fundamental repricing of a critical metal at the crossroads of monetary change and a technological revolution. Now, I want to hear from you. What do you think? Is silver heading for $100, or are we on the verge of a major correction? Drop your price targets in the comments below. And if you want to get my free report on the top 3 silver stocks to watch in this market, click the link in the description. Thanks for watching.